It's Charlie Munger who actually, well, I know it's Charlie Munger who has said that is one of the things that they look for. They want a company that is so easy to run and is run by fantastic management.
Right.
We're Compound Everything, and we discuss markets and investing and managing money and whatnot. And today we are talking about management.
Right.
Right, and those who run the companies that we're looking to invest in. Yeah.
So why do we look at management?
So I think, is it Charlie Munger who kind of came up with like the 4 M's? Maybe it was Warren Buffett and Charlie Munger together. So we're looking at management because it's one of the 4 M's that Charlie Munger's kind of talked about when they look at a business. So the 4 M's are meaning, management, margin of safety, and moats.
Right.
And so management in the eyes of Charlie Munger and Warren Buffett and many other value investors is a pretty important thing to look at. Yeah.
So we've been thinking about management for a little while and the importance of management in the businesses that we decide to invest in. And I think for a couple reasons. One is how good a manager is or management team is will dictate your returns, right? So the ultimate job of a manager is capital allocation. And so if they're very good...
I think Manish Barai said that is the number 1 job.
No question.
That the CEO has is capital allocation.
So is he or she a good capital allocator or not? If they're not a very good capital allocator, that will impact your returns in a negative sense. If they're a very good capital allocator, you'll get better returns.
Right.
So are they good capital allocators? The other thing we're looking for is honest management.
Yes.
And so if a management isn't honest, they can easily fleece the shareholder.
And that is very common.
That is very common. So you see that not infrequently. You see management taking disproportionate number of shares in terms of share-based compensation and things like that.
And even just lying to the shareholders, to pump the stock. I think recently there was a story that came out like a few months ago about the company Nikola, ticker NKLA, where they Trevor Milton, who was not an honest manager, I would say. And I think it came out that when they were showing, their truck moving, it was actually just
gravity powered.
It was gravity powered, not electric powered, and that is a very great example of a dishonest.
So instead of saying yes, our truck isn't ready yet, and actually taking ownership of that, they rolled it down a hill, and said that, oh look, our truck is fantastic and whatnot, and basically deceived investors.
And I can't remember where you heard this from, but you had brought up and you said one of the problems with having dishonest management is that you actually end up with other dishonest people throughout the company, because a person of integrity doesn't want to go and work for a management team that is dishonest. So dishonesty permeates within the culture of the company. When the top people are in charge, the entire company kind of gets
corrupt and dishonest. I mean, it goes both ways, right? Good managers won't tolerate corrupt people, employees, right? And vice versa. So I think management is extremely important, not only for your returns, but also corporate culture. And who do you want managing your money as an investor? Because it is your money.
And you are trusting these people with your hard-earned cash.
Exactly. So who is that? And so there's a few things that we look for in managers. So the first thing is, how good are they at returning capital?
I think that is the number 1 thing.
Well, I mean, there's a couple things you can look at. You can look at qualitative factors and quantitative factors. So we'll talk about quantitative first. So what are the quantitative things that can kind of tell you that a manager's good? Well, I think the number 1 is return on invested capital or return on equity, either or whatever. So how's that manager doing, and how's that company doing relative to other companies in the same or similar businesses?
And that's a very important point to make, is that ROIC, ROC, ROE, those are all important metrics to kind of measure the effectiveness of management at allocating capital. But you need to make sure you're comparing sectors among sectors. Right, because you can't be comparing, an airline
to a software company.
To an SaaS. It's just going to be very different numbers.
Exactly. So as a hard metric, I mean, that's, I think, a good, reasonable way to start. Or if they've maybe had a bit of a downturn. So what was that manager, let's say it's new management. So it's a company like, it's going to pull one out there, The Gap. So The Gap has got new management. And so are they managing to generate better returns based on what they were given?
Right.
Were they given
I think a better example, because the Gap is kind of going through they have an interim management, I think.
Sure. Okay, that's maybe a better.
A better example would be Intel.
Sure. Okay, Intel's a good example. So new manager, company's been struggling a little bit.
Getting its butt handed to it.
Yeah. So how is that manager managed to turn things around and regain market share?
And a side note on that is, again, you had brought this to my attention, and I'm not sure who said it, but that is one thing you have to keep in mind when you are assessing management. What is the hand that they've been dealt?
Yes.
What have they been given? You can't look at a manager if it's his first year in a company that's been floundering and say, wow, this manager really stinks.
Yeah.
You know, because they've been given a company to run. They have to kind of pull it out of the mud, right? But on the other side of that, if you have a company that's doing fantastic, and then they get this new manager,
and then it starts going downhill.
And then you're kind of like, how have you screwed
this up?
You messed this up. I think it was in the 1980s when they came out with new Coke.
Oh, yes.
And it was a disaster.
That didn't work very well.
No, and that's an example of like, what are you doing? Like, you were given this, it was like, any idiot could have run Coke.
Right.
And somehow this idiot couldn't run Coke. Yeah.
Well, that's one of the things that investors look for. Look for a company that any idiot could run, because one day one will.
Exactly. I think it's Charlie Munger who I know it's Charlie Munger who has said that is one of the things that they look for. They want a company that is so easy to run and is run by fantastic management. Right? They said that, I think his exact words is, that really turns us on. When they find when they find a company that is easy to run and its management is honest and excellent.
Yes.
He said that is a killer, okay, that's my word, but that is a killer combination.
So let's boil that down and summarize that a little bit. So return on equity, return on invested capital, good relative to other businesses in the same industry. And then what are revenues doing? So what is their top line doing? What is their income doing?
And what shape was the company in when the CEO was handed the
So you've got a new management, or maybe kind of newish management. What has happened since that manager took hold of the business? Is revenue increasing? Is what's happening with those metrics? So those are important things to look for. Okay. I was just saying in a quantitative sense. So if you're looking for numbers, those are a couple of good ways to look at that and gauge it.
And that's a good place to start.
It's a very good starting
because
place.
There are some companies that just do generally have better ROEs, better ROICs.
For sure.
Right? So it is a good place to start. I wouldn't stop there. No. I wouldn't look at a company and say, oh, their ROE is, pretty consistently 12 to 15%. The management must be great.
Right.
You got to go a little bit further. But that is a really good, you kind of weed through.
Yeah. So other things, this is getting into a little bit more qualitative
Which is much
harder. So the other thing that you might look for in a manager is, have they been able to execute on what they've said? So read 5 years of annual reports. So if this manager's been in the position for 5-10 years, read reports, read old reports. They said they were going to do X, Y, Z. Did they accomplish X, Y, Z? If they did not accomplish X, Y, Z, what did they accomplish? And did they give reasons why they could not accomplish that?
I was going to say, another thing to look for is not even if they are accomplishing what they said they were going to. If they don't accomplish it, are they acknowledging it? Or are they kind of just leaving it in the past and never bringing it up again?
Right, yeah.
That's not a sign of great and honest management.
Right. So I'm going to use an example here. One of the examples of that is a company I've been following for quite a while, which is BlackBerry. So BlackBerry took on a new CEO, call it 9 years ago, John Chen. He seems like quite an honest guy, in my opinion, after watching things and following the company for a while. He's boring, but
and a lot of people don't like him.
He's not got a lot of charisma there, but he's honest, and he's actually done most of the things that he said he was going to do.
Yeah.
Now, I would critique a little bit that one of the things that's been a little less than honest is the sale of their patents. So anyone's watching that and has followed BlackBerry.
They did get in trouble by the SEC for their accounting.
Yes.
Their general accounting practices.
Yeah. So that's
strike.
So it's a bit of a strike there. But the point being is, are they accomplishing what they said they were going to accomplish in the time frame they said they were going to accomplish it? If there's delays, why?
Right. Are they owning up to mistakes?
So those are kind of qualitative factors that we can look for.
And I think the qualitative factors, they are harder.
Much harder.
But they mean more.
For sure.
Right? They really mean more. And a management that can own up to its mistakes is quite rare. And a management that actually cares and realizes that they're managing shareholders' money. I find a lot of managements, a lot of CEOs and CFOs it's just a job to them. They're kind of mercenaries. They just come in. They're going to get their big bonus.
Right.
They're going to get their stock compensation. Many of them forget that they are handling the money of hardworking people. But if you can find a manager who knows that and respects that and understands that, that's a manager you want to keep an eye on.
Do they view shareholders as partners?
Right.
A couple other things. Do they eat their own cooking? Are they heavily invested in the company they're managing? If they have very little share ownership in the company that they're managing, you've really got to question whether they're efficacious managers. The other thing is, as you brought up, stock-based compensation. Are they compensating themselves excessively for the job that they've done? If they've done a good job, they should be rewarded well. If they've done a poor job, not so much.
But well can be extreme too. Even if the job is good.
Yeah, absolutely.
I think Warren Buffett at one point said, and I'm not going to say the number, but he said one thing they look at when they're assessing management and management's integrity towards shareholders is how much do they pay themselves out of the stock treasury, right? And he gave a number, and it was a very low number, and I don't want to say the percentage, but it was low because we were both kind of shocked, like, wow, that is a low number to look for.
Well, there's one company I've been following for a little while. It's not profitable, so we don't really have much of investment there, but it's the company had a market cap of something like I think it was $50 million, and the CEO ended up getting paid $7 million, which I thought was insane.
Yeah,
he got paid more than 10% of the market cap for the company.
That is warning sign.
That's warning.
So what is that? So recap that warning sign. The warning sign is when you can see what a company is making, and the CEO is making a very high percentage of that number in their salary.
And what's appropriate? I mean, maybe compare business to business. It's up to the prospective investor to go and do their own homework in that regard.
Absolutely.
Another thing to look for is debt. How much debt do they have? Does the management take out a fair amount of debt relative to other companies and things like that? A company that has no debt can't go bankrupt. So are they? What are they doing?
And with that, I mean, you can go quite into the weeds on the accounting there. There's a lot of financial shenanigans and accounting metrics that they can play around and fudge so that they can take out more debt, so that they can pump up their earnings. There are a lot of things. And that requires the investor to dig a little deep, right? Are they pumping up their price to earnings number? Right? What are they doing? Those are all things that would show dishonest management, and that would go into a much deeper study than just looking at the ROE and ROIC. So debt would be one of those, and you might want to look in like, how are they financing it, and what are they pumping up? But another thing to look at is share buybacks.
For sure.
And are they buying back their shares, and share dilution? So we don't like dilution.
No.
Generally.
No.
There are times to do it.
Right.
But we generally don't like. Are they just diluting the shareholders? And I was invested in a company a while back, and they were just diluting like crazy, and it wasn't a good investment. And that should have been a warning sign to me that they were constantly diluting shareholders, right? So that's an issue. And then another issue with buybacks is we love buybacks, but one thing that kind of shows buybacks can help pump a stock.
For sure.
And when the metrics are tied to your compensation. When certain metrics are tied to a CEO's compensation, you really got to watch the buybacks. And they might be buying back shares at a ridiculous price, which is actually not good for the investor.
No.
If they're overpaying for you want the management to be buying shares at a good value, just like you would buy shares at a good value. Right? So you also got to look at what that
goes back to capital allocation.
Right. What are the metrics that are tied to this CEO's, to this CFO's compensation? And are they doing anything to fudge that? Are they doing anything to pump up those metrics so that they get their payout? Right.
How's their stock-based compensation tied to that? One last thing, maybe not a last thing, but one other thing we look for is, what is their general tone in the shareholders' reports? I'm going to compare and contrast a couple. And these are just transcripts. I won't name the companies.
Will you eventually name them?
Sure, why not?
Okay,
so this is a conversation between a CEO, it's a conference call between a CEO and an analyst. And so the analyst says, I'll just break in, it says, so is it mostly competitive pressures? You could just help us to understand the thought process. What was for Q2? Thank you. And the CEO says, yeah, thanks. I think that is officially 2 questions, but anyway, we'll take them both.
Right, like they're doing, like this CEO is so compassionate. He's doing this analyst a favor.
Yeah.
Like, I'm just going to do you a favor and answer 2 questions. Like, no, you answer these because there's shareholders listening.
There's shareholders listening, and these analysts are asking questions on behalf of shareholders who can't.
Yeah, and that's not a red flag, but that's like the company still might be good, and this person might still be an okay CEO.
He very well might be.
But it's one of those things where it's like, he obviously doesn't feel that he needs to answer these questions for the shareholders. It's a way he probably feels like I could be doing something better than answering these questions.
For sure. He seemed it sounds like the tone seems a little put off.
Yeah.
Compare that to this one.
Okay.
And so this is a conference call, another CEO.
Yeah.
This is the operator. It says, and this does conclude the question and answer session of today's program. I'd like to hand the program back to CEO for any further remarks. And this CEO says, thanks, Jonathan. This is a new system. So again, if anyone still has questions, try to get in. We're still working a little bit with different audio video sort of system for the webcast or for the conference call, but hopefully people are managing to navigate it. So he's probing for more questions because I think maybe only 1 or 2 people got through to ask questions. He could have easily cut it off and said, you know what, done, great. I don't have to answer any more questions. Now this same CEO of this same company gives a monthly update to shareholders.
Now this guy is the reason we decided to talk about management, because we have never seen a manager
give a monthly update. On the company. Yeah.
Okay, so go ahead and tell us, who is the first company?
So the first company is Intel.
That does not surprise me at all.
Yeah, it's Pat Gelsinger.
Yeah.
The second company is a small Canadian company called Peyto Exploration.
What's the ticker?
The ticker is PEY.TO. And it's the CEO's name is Darren G.
Okay.
So this is probably one of the model CEOs in terms of just being shareholder friendly that I've seen. A monthly shareholders report. Monthly. He goes through it. I've never before read a monthly shareholders letter where the CEO explains so well what was involved in their business.
Yes, and it's a natural gas company.
It's a natural gas exploration company.
And I've actually read, so I'm not invested, so I haven't spent too much
time.
I'm
not invested.
But I've read a few of the reports you give it up, and he is so knowledgeable that he was able to write in a way that I could somewhat understand that type of business. And I have no background in that. I don't understand.
Likewise,
and I have much more of an idea of the natural gas business now because of his letters.
Oh, no question. So again, just seems like a very honest manager who views his shareholders as important.
Right, and that he has a job to do, which is not just running this company. It's running this company with the idea that he is the steward of other people's money.
Yeah. And he eats his own cooking because he has quite a number of shares himself.
Yes, exactly.
Just compare and contrast the two managements.
And that's the manager who kind of got us on like, wow, this is the standard to which we are going to hold all managers to. And we know Buffett writes a very honest shareholders letter every year and has been doing for decades, right? And in his shareholders letter, he is always mentioning mistakes, always bringing up mistakes. We read one by Bill Ackman recently, and he made a comment saying, was that a bad investment? Yes, we could have done better with our shareholders' money. So, he called it as it was. He didn't try to dance around the fact that they didn't make a mistake and whatnot. And one thing I was going to say was, this goes back to Intel. So in their last earnings call, or maybe I think it was their last earnings call, one thing I was not a fan of that last earnings call that they had.
I know you weren't. Yeah.
Just got bad vibes all around from the CEO there. But one thing that kind of dawned on me while I was listening was, if a CEO answers a question and at the end of it you are thinking, oh yeah, good answer. But then you step back and you go back to the question and then you really parse through the answer. If there's no answer, but you were left thinking that there was an answer at first, that's a shiesty person.
Right.
They know what they're doing. They know that they are saying nothing, but making you feel like they're answering. Yeah.
So I think it's important to listen to the conference calls. Take in as much information as you can about the...
Tone is telling.
Yeah.
The listening is better than reading. I prefer reading because it's faster.
Yeah.
But tone is telling.
Yeah. And I think the cardinal red flag is what happened in the Enron conference call, where the CEO swore at the analyst.
The guy to FO.
I think he did.
Yeah.
So if you have something like that, you should sell your shares.
Yeah. I really do like, though, when a CEO on a conference call, and I've seen this a few times, and it's generally founders.
Yes.
And that is why we do like founders, because they are generally just so excited. Like, this company is like their baby, right? But I love it when analysts will ask a question. Like, I was listening to a conference call of a smaller company, and an analyst asked 2 questions, just like the one that you.
Yep.
And instead of saying something like, well, that's actually 2 questions, but we'll answer them anyways, he said, I am so glad you asked 2 questions, because those are both questions that I have really been wanting to answer.
Oh, well, there you go.
Look at the difference between, like, oh, you did this, but I'm going to be so kind to you and answer. Whereas this guy was like, I was really hoping that someone would
ask these questions.
And he was just so happy. And then the other thing I love is when they are just so excited about their product.
Yes.
Right?
Well, because they're going to work hard.
Right.
You know they're not just there to punch a clock.
Right.
They're there because they love the business they're in. They want to see it succeed. And you know they're going to work hard.
Yeah.
As investors, that's what you're looking for.
Yeah. So I think that kind of sums up all of management. It wasn't a long conversation, which is interesting, because when you actually look into management, it's a long and
it's a long process. I was going to say there's not too many things I don't think to look at. I think a lot of them are qualitative more than quantitative. But I think both can be helpful.
Right, but the numbers kind of point you in the right direction.
Yes.
I find that the quantitative part of it is kind of what it screens it to make it a little faster. So I can be like too hard. And then I find a company where the metrics are really good.
Yeah.
And then I'm like, okay, I'm going to look into this one, because it would be really time consuming if, you didn't have those metrics there and you were going through like decades of annual reports on hundreds of companies, right, and all that. So it is a nice screener to get it down to a
For sure. Now, it goes both ways too, right? You could have a CEO that's, quite pleasant and views shareholders as partners and things like that, but just can't execute.
Yeah, and they love their company.
And they love their company.
And they're really excited, but it's just like the numbers are bad.
But the numbers are bad.
You want to avoid that too.
You should avoid that too. Honestly, as much as you may like the person, you can't invest in the company.
Yeah, that's right.
So it swings both ways.
It goes back to what Charlie Munger said. When we have a company that is very easy to run, and it doesn't cost a lot to run, very low capital, and we have management, it really turns them on.
Exactly.
That's what we want.
I think that's a very good summary.
That's what we want.
Yes.
So if you have any examples of really great management, you can leave it in the comments.
Oh, we always love to look into that.
I encourage you to go look at some of the letters from, what's his name?
Darren G. at Peyto Exploration. It's ticker PEY.TO.
Yeah.
And if you're interested in the natural gas space, go read his monthly shareholder or monthly report letters.
It's definitely a good example of a good CEO. And of course, go back and read the Berkshire Hathaway shareholders letters. That will give you a framework for what to look for when you're looking at a CEO and whatnot.
And who actually views his shareholders as partners.
Yeah. So that wraps it up, and
thanks for joining us.
See you next week.